All right. Well, good afternoon, everyone. Good day to you. My name is Dr. Beto Pallares. I am the chairman of the Cruces Angels. I'm an El Pasoan and a professional investor. And joining me today is Jack.
Yeah, I'm Dr. Jack Loveridge. I'm also an El Pasoan. I spent about 18 years away starting in 2003 and came back during the pandemic to set up my startup here in El Paso. I'm also the co-president of Stanford Angels and Entrepreneurs of Texas.
Wonderful. Before we get started, I want to recognize partners in this endeavor, which is Cruces Angels. First of all, NMSU Arrowhead Center. Great supporter of regional economic development, as well as the entrepreneurial ecosystem. We thank them for being our academic partner in this endeavor, as well as the STT Ventures, which helps nurture entrepreneurship in the region by working directly, hands-on with entrepreneurs, often from K through 12 through college and beyond. The Stanford Angels and Entrepreneurs of Texas chapter, which Jack represents. It's great to have an affiliation by way of partnership with such a prestigious institution. Joseph Advisory, which is a registered investment advisor, forthcoming soon, manages a number of private funds. Adaos Capital, which is an early stage venture capital fund, and the Paso del Norte Foundation. Thank you to all of them for being partners in this endeavor. Now, let's talk a little bit about the background of the Cruces Angels, its mission, vision, and why an angel network is vital for a region. Oftentimes, communities develop a need for investors because entrepreneurs need capital. And oftentimes it's purely driven by a financial stake in a company or an endeavor that will ultimately provide a return for the investor. That's also the mission of SCA. However, we're also aligned for impact. We want to continue to nurture the entrepreneurial ecosystem in Las Cruces and El Paso, and continue to nurture the fact that a number of high net worth individuals or individuals interested in investing can have a partner organization like SCA as a reference, both for education and for vetting deals that they might do within the region or even outside the region. So the mission is to be a partner to the entrepreneurial ecosystems in the region of Las Cruces and El Paso. And the vision is to be a premier angel group active in the region, helping source, diligence, and structure deals for the benefit of the region and the financial benefit of the investors. Why have an angel group? Why is it vital? Many times angels are the first line of defense for an entrepreneur to get funding. This funding comes from the capital that individual angels, either as individuals or collectively as a group, invest. The money that these angels are investing is their own money. This is something that they've made through years of hard work, through selling a business or what have you, perhaps even inherited capital. But they're investing in entrepreneurs and in businesses to develop them from a very, very early stage and therefore scale them up so that they're larger, more viable businesses. Startups everywhere need angel groups. And there's even a national and an international association of angel investors that provides lots of data. And perhaps, Jack, you can speak a little bit of some of that data.
Absolutely. Thanks, Beto. One of the things that really stands out to me regarding angel investment is that nearly $25 billion are invested per year by angels in the United States. These aren't large venture funds. These are professionals who have amassed a great deal of knowledge and capital through their endeavors in life, and they're able to help out other entrepreneurs launch their own enterprises. A great deal of angel investors were entrepreneurs themselves, but not all. So it is an open door to pretty much anybody who has an area of expertise and who is looking to improve their community, improve the ecosystem more generally. There's about 70,000 startups nationwide receiving such investments per year. And this is as of 2021. The numbers go up and down slightly with the economy.
Right.
But that is a very robust figure, considering how many startups we have total. 22% of those angel investors in the United States are women. So this is an underrepresented group. Minorities generally are underrepresented as angels, and so those numbers ought to come up with time and ought to come up with efforts like these. What you need to remember, of course, that 5 to 10% of startups that receive angel investments will deliver you a profit. So it is, like any investment, something that needs to be done wisely, done with a great deal of due diligence. So there are no guarantees whatsoever, but you should be comfortable with some risk. But angel investors with 12 investments over a period of 5 or more years have a 75% chance of a 2.5 times return. So the idea here then is portfolio diversification, engaging with the startups themselves, meaning it's not simply a capital transfer. It is a transfer of knowledge, expertise, and experience as well. So you have that mentorship relationship that continues over time. And also having a reasonable amount of patience is helpful, staying in as long as the indicators seem to be pointing in the direction of positive returns. So what helps with de-risking that process is being part of an angel investment network. This is borne out by the data. And having access to advising resources. These are huge helps as you make the transition from a professional into angel investment. Working in a group helps to draw upon the knowledge of others, and that is a proxy for experience in a sense. So, we can go a little bit more into the numbers as we go on, but a quote that really stands out to me is from Paul Graham, who is a computer scientist, an investor, and a Y Combinator co-founder. He's based in the Bay Area. So there probably aren't more than a couple hundred serious angels in the whole of Silicon Valley. And yet they're probably the single most important ingredient in making the Valley what it is. Angels are the limiting reagent in startup formation, using a little chemistry term there. If there are only a couple hundred serious angels in the Valley, then by deciding to become an angel, you could single-handedly make the pipeline for startups in Silicon Valley significantly wider. And so that's kind of mind-blowing, he says. And I think it is mind-blowing, and it doesn't necessarily need to apply exclusively to Silicon Valley or Boston or New York. It's something that we can do across the country. You see this with Austin. You see this with a city like Miami. They've invested locally and helped to counter brain drain effects by keeping those great startups and new enterprises homegrown. So I'll hand it back over to you, Beto, and I can also give you a definition of angel investor. I think that's next up on the list.
Sure.
Generally speaking, an angel investor is a high net worth individual who invests their money directly into an emerging business. These are early stage companies. They're at every point from ideation up to going into larger scale VC investment. And many angel investors are accredited, and the great majority of them are entrepreneurs themselves. But again, having that professional experience, having that network, and knowing your field seem to be the main requisites for joining the club of angels.
Yeah, I'll add to that is super important, because when an entrepreneur is very early in their entrepreneurial journey, they need someone that's been there, done that, hopefully in the similar or the same industry, and can help them avoid a lot of those pitfalls. And the accreditation component, that's something that is set out by the SEC. That's the accreditation standard for an angel. It's not something that a specific angel group decides. Let's go into some Q&A that we have.
Absolutely.
Okay, I'll start. How much or what minimum or maximum investment am I expected to invest if I become an angel? Well, for the purposes of St. Cruces Angels, typically individual members are expected to invest a minimum of $10,000 per year. This can be spread across 1 deal, 2 deals, 3 deals, 4 deals. In other words, you could do 2,500 into one deal, 5,000 into one deal, 10,000 into one deal, or split it up. There is no minimum investment. You can invest more depending on the type of deal. You can invest above that 10,000 number I'm providing. Sun Cruces angels can help decipher the nature of the deal and syndicate the structure or the syndication structure. Syndication is the process of gathering other angels or investors with whom you share the investment and you collectively make the investment in the deal. The maximum investment, as said before, there is no maximum. Members can invest as much as they are comfortable, given the deal terms and their own personal financial consideration. So that's a little bit of how much to invest if you were a Sun Cruces angel, and what are some general expectations.
So for somebody who wants to become a Sun Cruces angel, you'd be curious as to what types of terms you'd be investing in. So investments are primarily made in the form of convertible notes, and I think we can discuss this in greater detail. Some of the terminology might be a little opaque to first-time investors. There are safe notes, meaning simple agreements for future equity, or priced rounds, which I think tend to be rather common. Terms vary by deal, of course, but common terms include a valuation cap, a discount rate for convertible notes, an equity percentage that goes to the investor, typically 5, 10, 20% is the max, and terms related to investor protections like pro-rated rights, liquidation preferences, and anti-dilution provisions. And I think we should dig into these terms a little bit because they're opaque to pretty much anybody in entering the entrepreneurship space, and they may well be something that is worthy of clarification for new investors too.
Definitely. I will add that sometimes in an angel group, attorneys also join as angels themselves and invest. And it's good practice to have access to an attorney that understands these terms so that they can help the other angels who are not professional attorneys understand some of these terms. But these terms are widely known in the angel and venture capital community as mechanisms by which the structure of an investment is put together, like the safe that Jack described, or the convertible note, or even a price round. These are the terms under which you're going to do a deal and how much you're going to owe, given the other specifics around that specific deal. So they are important, and we'll dive into those with some level of detail. And there's lots of great resources, and we'll provide resources in terms of books and primers. And we'll have other sessions where we'll go into specifics of deconstructing a term sheet, looking at a safe note, looking at a convertible note. And we'll also have a session on what does it look like to do my very first deal? What should I be looking for? What are the pitfalls and what are the resources that are available? I'll talk a little bit about diligence. Due diligence is the process of understanding the deal and making sure that if it's a duck, it sounds like a duck, walks like a duck, quacks like a duck, it's probably a duck, right? So if someone says, I have a new kind of software that does XYZ, your diligence should include who built it and what program. Is it robust? Is it secure? Is it appropriate for that industry? So if it's for the medical field, usually you need HIPAA compliance. Are you hosting on a server or the cloud or on the edge? Do you have the right team that's going to take this forward? Do you have a first customer? In general, there's just a litany of things that you can go through to do due diligence. Has the entrepreneur done something in their past that we should be aware of? Maybe they went through bankruptcy. Maybe they don't have actual experience in this industry. Or maybe they actually have a graduate degree in this particular field and spent 10 years working in it and know a lot about it. So your due diligence is just making sure you understand these things. For instance, if you were going to buy a house, they're going to pull title on it, make sure that the title transfer is as it is. They're going to do a survey of the land to make sure that the boundaries are what they're represented to be, etc. So in doing an angel deal, the due diligence is a similar process. You're gathering documentation and anecdotal evidence that the deal is structured the way it should be. And what the entrepreneur is telling you they're doing is exactly what he or she is providing documentation for. Due diligence takes time. and due diligence can be very complicated. If it's a very early stage deal, it's an idea with a PowerPoint and someone with a small prototype, maybe it's not so hard to diligence. But if the company's been around for years, maybe it's gone through a lot of ups and downs, that could take a lot longer to diligence. So diligence is just the idea of finding the financial information you need, the market potential, the competitive landscape, the team background, and any potential legal or regulatory concerns that you need to consider. After an initial pitch, if there's a member interested in the angel group in saying, hey, I want to dive deeper into this and do the diligence, that's usually how that happens. Or, hey, I'm really interested in funding this. I need to understand the terms under which we're going to consummate a deal and maybe even bring other investors. So in that case, that angel that steps up, he or she is the lead in getting that deal done and helps promote the deal within the other angels.
And that really is the benefit of having a network. That is the benefit of having a group of angels to share knowledge, to be able to share the burden of doing this due diligence process. And it's a two-way street. Entrepreneurs also want to know that their investors are who they say they are. They are working with other companies and they are seeing success. And so to de-risk that process is something that you can achieve very quickly working through a network. And that's one of the strengths of something like SCA.
That's true.
So a question that I think is a little more regionally specific is what industries, what sectors apply to seed investment? Here in El Paso, we can think of a number of sectors, but SCA has a very broad interest and just wants to see emerging regional industries and technology-driven startups as point number one, especially those in software, healthcare, financial technologies or fintech, and clean energy and sustainability. These are key growth sectors that can really propel a regional development. And generally speaking, in the major hubs in San Francisco and New York, these are the areas that have been taking off over the past few years. And so to use those indicators nationally as a way of guiding our investments here in the region, we can piggyback off of longer term, I should say, transformations in the overall economy. So after initial pitches or after initial applications from startups, we'll have a good sense of what promising enterprises exist in the region, and then we can go from there. So we're looking for any innovative company with a compelling value proposition. And so that's a very wide net, and it'll be on SCA generally to do that curation of those deals. So we make sure that we're delivering high quality deals to our members.
Right. I'll speak a little bit more about the sectors and why, say, software or tech companies are particularly interesting. It doesn't mean that an angel investor won't invest on, say, a restaurant or a logistics company with lots of assets like trucks. Those are very good investments. But some of those investments may not necessarily scale as quickly, or maybe after one angel invests in it, that company may not need any additional capital or even want it, right? The other reason why tech or software is particularly important is because the type of entrepreneur that starts a small business, like a dry cleaner or a restaurant, needs a certain kind of skill set and needs to hire people with a certain kind of skill set. And the potential for that business is usually defined by its geography or some consumer pattern of sorts. So if I want to go out for dinner close to my house, your average customer is going to come from a 5-mile radius. They're usually going to visit that place. You can expect what to eat at that restaurant. If that person that's an entrepreneur opens a second restaurant on the other side of town, it's not likely that I become a customer. It's likely that they're looking for new customers. And maybe that person that started that restaurant is happy running 1 or 2 restaurants. A software company or a tech company has a very different profile of entrepreneur, different kind of background, and needs to hire and compensate employees in a very different way. And there's greater risks because you're competing globally, not just locally, for customers. And you're competing for capital, and you're competing in many other ways. There's other complexities to startups. It's just a different game, if you will. So angels can lend a lot of advice on governance and strategy and whatnot. But the reason why you ought to be excited to invest in tech companies is because at no time in the history of humanity have we been compensated for what we know. And tech investments can dramatically accelerate wealth creation, not just for the entrepreneur, but for the investor. So if you run a restaurant and you sell that restaurant, you might sell it for one time the revenue that you generated in a year. If you run a software company, you might sell that for 10 or 15 times the revenue that you generated in a year. It's just a different type of entity with high levels of risk, but also high levels of potential reward financially and strategically. Strategically, Sun Cruces wants to help vet and back software companies or tech companies, because that could change the landscape of employment, wealth creation, and industries in our region for the better.
Hugely transformative and hugely scalable as well.
Right.
So I think we're thinking about our first deal at this point.
Correct.
I can hand that over to you.
Sure.
I can come back.
Sure. So we will have a separate session
Yep.
On how to do your first deal. But you should know that if you join Sun Cruces Angels, you're going to get a fair amount of handholding, help on the vetting and due diligence, structuring of the deal, syndication of the deal. We can connect to other angel groups in other parts of the country or other sources of capital. And we can help set up mechanisms to help monitor that investment over the course of time. We'll have a separate session on how to get your first deal done, from the legal, the diligence, the financial, the oversight, and the help that you can provide that company. Right now, I'd like to speak a little bit about other implications that are important to an angel investor. Say, for example, taxes.
Yep.
When you invest in certain kinds of companies, right? Manufacturing companies, software companies, as an example, there's something in the tax code, which is the QSBS structure, if you will, and it's a tax advantage. It's a qualified small business stock. And basically, it's a tax benefit to the investor in that type of company. You have to have been invested in the company for about 5 years, and there's other mechanisms that go along with that. So making an investment of your own capital in the right kind of company also has benefits that are good for angel investors. I know that in New Mexico, the state of New Mexico actually gives you a tax break if you as an angel invest in companies in the state and you're paying taxes in New Mexico, you get a credit on your taxes that you pay because you deploy capital into the economy to do that. There's other places like Hawaii where that tax rate can be as high as 50% of what you invest in. They're giving you credit for 50% of the dollars you invested in angel deals back because you pay taxes in the state of Hawaii. So those are some implications that are important. And, SCA can help understand those things by bringing in the right kind of resources, tax folks and the like, to help us work through that.
So many investors will ask, how long is it going to take to get a return? And that is a good question. Returns on angel investments do vary widely. And like I said earlier, one of the main things is to stick with it for a reasonable amount of time and also diversify the portfolio so that overall you're investing in a group of companies and not just a single one where you have an entire nest egg or some large amount of money put into that one enterprise. And again, that's a great advantage of this kind of a network where resources are pooled, knowledge is shared, and those elements that increase the odds of success are all in place so that we're all working toward the same goal for the region. But to answer the question, 7 to 10 years is where you might expect a return, at least a few years. especially if the company goes through multiple fundraising rounds. Here we are at the threshold of a long experience for a company. You're at the beginning of the life of a new enterprise. And so, like a child, you're going to have to watch it go through its growing pains. You're going to have to see it take its first steps and then go off as you exit and they exit, hopefully in a very profitable way for all involved. So it's essential to understand that this is a high risk game, like anything else that you would put a little bit of your heart and soul into. There's no guarantee of return, but when the returns do come, it's something that we can all be proud of, and it's something that can really help the region generally. So those are the things to keep in mind as you take these first steps into the world of angel investing.
Absolutely. At this time, we'd like to open it up for questions from any of the folks that joined us during this live session. Feel free to raise your hand or interject.
Shout out.
Shout out. Look, one thing to keep in mind is a single angel can probably do a lot and travel very quickly through understanding some of the things in a particular company. But as the old adage says, if you want to travel fast, travel alone. But if you want to travel far, right, go as a group. And so an angel group allows you to really plan long term and really plan into the future, because when you make an angel investment, you're essentially locking up some portion of capital for a fair amount of time, but that capital shouldn't just be sitting there. Something's going on, and you as an angel are actively engaging with that company, supervising, advising, oftentimes doing more than that, connecting them to others. So it's super important that if you're interested in investing in tech companies or companies of impact or the different sectors that we described, that you do that through a group, or at least have access to a group to augment your resources as an investor. Any questions from folks? Rui Ping, I hope I'm pronouncing your name correctly. Kindly correct your name spelling.
Yes. Hi. Thank you for sharing all the tips and tricks. And actually, I met Jack a few weeks ago in the Stanford event.
That's right.
Yeah, I'm very new to the investment, and I myself is also an entrepreneur. So my question is, for early stage startups, how do we evaluate the company?
How do you value the company?
Yeah, how much is it worth in terms of early investment?
Let me take that one. So number one, there's usually data out there that says what companies are getting funded at what stage and how much money they're raising. And there's also resources. One of my favorite ones is Wilson Sonsini's website, wsgr.com, where you could look at the entrepreneurship report published every quarter that gives you stage of funding by type of company and industry and dollars they're raising, and also the pre-money, which is how much the company is thought to be worth before any new money is raised at every stage of financing. So it's a great comprehensive report. It just came out last week for covering the first half of 2023. You also talk to other entrepreneurs. You talk to other investors and say, I'm raising this much money for this kind of company, and here's the value I'd like to see for that. And ultimately, there are data sources. There's Crunchbase, there's PitchBook if you have an account for that. There's lots of public announcements of companies raising money and the valuation. There's accelerators, and there's also professional investors you can talk to. There's a plethora of published reports that talk about valuation. But ultimately, you also have to keep in mind the stage of company. So if it's an early stage company, clearly the value will be less. And then you have to raise capital at a certain amount or a certain amount of capital. So your pre-money, which is what you're raising at, plus your new money equals your post-money. And then you have some metrics that you want to meet to grow that company. ultimately the value or the valuation is set by the marketplace. You're an entrepreneur, you talk to several investors, one of them says, I'll give you $1 for 20%, another one says, I'll give you 10 cents for 20%, and one might say, I'll give you $5 for 20%. So if you ever seen the show Shark Tank, you usually see that the discussion is around valuation when the sharks are saying, well, I'll give you 100,000 for 10% of the company. I'll do this, I'll do that, or that's not worth this. So it's really complex. It's very important. And it's also why some terms in angel investing have evolved, and some tools like the SAFE, right? The standard agreement for future equity developed by Y Combinator originally as a way to figuratively kick the can down the road on valuation. So you can get the funding you need, you can execute on what you want to do, and then you can say, see, we created value. Let's now go out with more certainty and raise capital at a certain valuation. So this is a complex issue. It's something that every investor and every entrepreneur will deal with. Hard to answer and pinpoint because it's very specific to every company. I hope that's helpful to you.
Yeah, it's very helpful. Thank you very much.
It's a process.
It is a process.
It's a discussion that's ongoing. It could take weeks, months.
That's correct.
Thank you.
And I just wanted to thank Carlos for putting a few useful links into the chat. If you check those out, it'll take you, I think, to Y Combinator and to also a few other resources.
Excellent.
But Carlos has a question.
Carlos, question.
Perfect. Thank you. Good afternoon. My question just relates to the previous question. Do you know, like on average, how much a startup would give to an angel investor as a percentage of the company? Like, is there a common practice there, or how does that play out?
Good question. There is a common quote unquote range of equity or ownership that you're giving up. So very, very, very early stage companies, right? Usually called pre-seed companies, right? A seed grows or germinates. Pre-seed is even before that. So you have to kind of bookend the amount of money that you need. So I'm going to go out on a limb and say that a pre-seed company is raising up to $1 million. A seed company is raising up to $3 million. A Series A company is raising $5 to $10 million. Okay. Now, at each time that you're raising money, you don't want to give up. Okay. This is an investor telling you this. You don't want to give up more than 20% of the company. Okay. Because let's say in your seed round, you give up 30% for $1 million. Then you go out and raise more money at your, you give up 30% at your pre-seed round. Then you go out at your seed round a year later to raise $2 million. So you give up another 30%. And then in your A round, you give up another 30%, right? So over the course of 4 years, you gave up 90% of the company. You now own 10% as a founder, and you still got 10 years of work to do. And you only own 90% of the company, right? So ideally, you don't want to exceed more than 20% in any round of financing. That's where, to the point of the previous question, there's always this tussle between what am I worth and how much am I selling of this company, right? I need $1 million. So do I sell 1% for $1 million and I keep 99%? And then maybe the answer is, look, it's still very risky. It's very early. $1 million ought to buy me a bigger percent. Okay. And so, if I had a magic wand, I'd want every entrepreneur, by the time they exit the company in those 7 to 10 years, I want every entrepreneur to still own no less than 20% of the overall company, hopefully more. And you only do that by being very diligent and careful how much you sell. You take just the right amount of money that you need. You hit it out of the park in terms of the performance of the company. So when you raise money again, you raise at a higher valuation. So maybe a pre-seed company raises money and sells 15%. And at the next round, they sell 15%. And at the next round, they sell 10%. But each time that pie is getting bigger. So even though they're selling a slice of the company, they're selling a smaller slice percentage-wise for a bigger price, well, a greater price. Does that help give you some guidance?
Yeah, definitely. Thank you very much.
Joseph Sapien, do you have a question?
Yes, you mentioned earlier about the New Mexico tax incentives. What do they look like in Texas?
There aren't any. And part of the reason is because we don't have a sales tax, we don't have a income tax in Texas. And usually states or state angel credits are negotiated at the state level as a way to reduce your income tax burden in the state in exchange for your activity as an angel investor. And usually those amounts are capped. So I don't remember the amount in New Mexico, but let's say that New Mexico says, we're gonna give $5 million in tax credits in total. So the first angels that come to us and give us paperwork to show that they made an investment in a qualified startup operating in New Mexico, we'll give that individual angel up to $250,000 in tax credits for their investment. You know, so in Texas, we don't have that mechanism. Now, I'll digress and say that I have the idea that we ought to do that at the county or city level and give a tax break on either property tax or sales tax.
Yep.
And the city can cap it at $1 million in total, and no angel can apply for more than $10,000 of tax credit if they can prove that they provided $10,000 of investment to a qualified company. But the reality is that those programs take time to develop and time to administer and validate. Then the state has to set up someone that's going to do due diligence to validate that that investment indeed was made, and so on and so forth. So while it's a great incentive, it's not used in every state for a variety of reasons. Does that answer your question?
Yes, thank you.
Any other questions? Jack, any other thoughts on some of the activity you've seen in the Stanford Angels and Entrepreneurs chapter?
Well, I'll say a little bit about the chapter
Please.
To begin with, and why we founded it. So I'm a co-founder of the chapter with Alec Walker, who's based in Houston. And we set it up during the pandemic because we thought that Stanford's presence should extend beyond Palo Alto. There are 9 to 10 other chapters that are active around the world. So this is an international network that had no real meaningful presence in Texas among Stanford alumni. So when we launched the chapter, it was a sort of sluggish process. But once the message got out, once people understood that what we're trying to do is expand this ecosystem here in Texas, is support innovation across the region. And that includes southern New Mexico. It includes Chihuahua and the states of northern Mexico as well. We saw a great deal of traction, and the fund is essentially it's individuals. It's not a pooled fund, so it's somewhat different from the SEA's model, but it is involved in a great deal of activity across Texas. We have events in Houston, in Austin, and like Rui Ping said, at the Stanford campus just a few weeks ago. So we try to remain as active as possible and create a sort of fellowship among investors, and the public is welcome to participate in our events, and 10% of our membership is non-Stanford alumni. So recently we've seen a great deal of activity in AI and machine learning, biotech generally, any sort of medical devices. These things are always in high demand. And the Stanford network also provides a great deal of deal flow. We have a lot of great startups that come across our desk, our proverbial desk, I should say. And so the opportunity to get involved with something like SCA here in El Paso, here in Las Cruces, it's just, how could we say no? How could we not get involved? How could we not share our resources and see how we can be of help, and also how the two organizations can bolster this ecosystem? So we're just excited to be a part of it, and we're always available to provide advice. We're always available to open our network to anybody who would like to utilize it.
Thank you for that. That's a great resource, a great partnership for a region. And it also shows the power of shared trust. You know, someone who went to Stanford, you know them, you know, a little bit of their trajectory, you know, a little bit of the, call it the quality of their education. I would say that a lot of that would also apply for members of an angel group.
Absolutely.
Or maybe an affinity group like UTEP alums and MSU alums who say, hey, I want to participate in back deals started by alums from these universities or in this region. And so it also extends as a vetting mechanism, but also increases the trust factor among people participating.
Excited to be a part of it.
Great. Well, unless there are any other questions, I just want to tell people that our next session will be a session on due diligence in the first deal. We'll go into some detail and we'll do a case study of a deal and walk through the various mechanisms, as well as if you join SCA, what does it mean, you know, dues wise and whatnot. You could also go to www.suncrucesangels.org and you'll see a lot of resources there. You have a great FAQ and a way to join. It is a nonprofit, so your contribution is tax deductible as well. First year is $750 to join. $250 is to get you some nice swag, and the $500 is the membership fee annually. Anyway, we are welcoming new members. We have some exciting events coming up where you'll be able to see deals. We have the Aggie Shark Tank coming up October 5th. We have Dios Muertos pitch contest November 1st through 3rd. We have a number of hackathons that will be taking place in the year ahead where different startups emerge and need angel help, angel investors and mentorship. So all of that are great events, great resources, and we hope you consider joining the Sun Cruces Angels. With that, we'll hand it back to Carlos Morguia at New Mexico State University's Arrowhead Center, who has kindly helped facilitate this Zoom session.
Thank you, Beto, and thank you, Jack. I'm going to stop the recording.